Didn't get the answer. Who is recording the class?
What's your question again?
Who is recording the class? Someone told me that. What is it? Что? I don't understand this. Who is recording the class?
Just translated in the chat.
Sorry?
Atabek just translated your question in the chat.
Okay, so what we are going to do now is to start from. You tell me if you hear me well or not, okay? So you can adjust the microphone. But what we are going to do now is to start from this slide. And the slides that are before this were explained to your colleagues. So as an exercise, you exchange with them, you study by yourself those slides, and then you exchange your views with your colleagues. And then, of course, if you have questions, you ask me. Next class, that would be the 20th. So let me start the presentation.
Excuse me, will it be possible for us to understand the further material given the fact that we are not familiar with around 20 slides, as I get it?
I don't understand your question. So say it again, please.
So now we continue from our 24th slide, or from
No. I'm going to show you the presentation, then you will see it, okay? No, it's not this one. This one. Can you see it? Can you see the presentation? Okay. Yes. So we stopped last time. We ended here, no? We were talking about markets, and we said that there are many securities in the world. Then we need a sample, and the sample is normally is index. And there are very many ways to make a sample, and then there are many kind of indexes. So then you have to study this as an exercise. You have to study this part until here that I already explained to your colleagues. And today we start from this, okay? So from this slide that is number
Can I ask a question?
Of course. Just let me finish first, and then
okay.
you, just a second. So as an exercise, I said, you study by yourself this. Then if you can also ask your colleagues if you have problems in understanding something, you can ask your colleagues. But then next class, we will solve all your questions, doubts, whatever, all together. So in the next class, I said. What was your question, sorry?
I wanted to ask, will this situation always be so? Our group has a lesson after another group, and we should study some of slides by ourselves every week.
So it depends on your preference, because this could be a way to learn and to try to understand the material. But if this is not fine with you, so we are making a test, okay? If this is not fine with you, then we will not split anymore the class into parts. So everyone is free to join the previous class. Anton?
I understood. So, can our students from our group attend the previous class and
Yes. Yes, and also the opposite. This time we will do in this way. And then if Thursday, what is it? Thursday, let me check. Yeah, Thursday, if you want, you can we can start from 15:20 all together, I mean, everyone, and finish at 18:30, like we did in another situation, I mean, when it was, let me check. It was the 8th, no? The 8th, we did it in this way. So you decide what is better for you. This is, as I said, this is a way to test if you can learn without me and with the help of your colleagues. But again, whatever is you don't understand, if you have questions, doubts, whatever, we will discuss those doubts the next week, the 20th. No, the 20th. I remember that we should have another class. Correct?
Yes, correct. But wouldn't it be easier to just arrange one seminar for the both groups? Because
Is
our
what I said.
groups.
Is what I said. You have this option next time. So next time, that will be the 22nd. You will be free to attend from the beginning.
Yeah, but we have only one lesson in the timetable, not two.
Doesn't matter. You can attend without any problem.
Okay.
It's your option. If you want, you do it. If you don't want, you don't do it. Okay? It's fine, Nick.
Yes, it's
And
clear.
and also the other group. People from the other group can attend your seminar without any problem. Okay, so now let me start from what we said last time. Elvira,
Yes.
can you please summarize what we said last time?
Last time we talked about the risks, its type, like business risk, financial risk, liquidity, exchange, and country risk. So we
Yes.
had examples with the cars. Then
And why risk is important, Elvira?
risk is important because we should know what rate we should know the risk to
Elvira, let's say that you are an investor, okay? Yes or no, Elvira?
Yes.
Okay, so if you don't hear me, you ask me to adjust the microphone and to repeat the question and so on, okay?
Mm-hmm.
Now, let's say that you are an investor.
Yes.
What you see on the market? Do you see the risk or you see something else?
I see
What?
the share price.
The price, okay. So when you go to the market is not only about securities, for example, it's also for bread, no?
Mm-hmm.
If you go to the market, you buy bread, you buy vegetables, whatever, no? What you see there? You see
The good
and
the price.
the price, okay. So, and why risk is important?
To know what the price should be.
Exactly. So if you have two options, one is very, very risky, another one is much less risky. What you choose?
It depends on what return I give.
You
I
get.
want to give.
You get.
Mm-hmm.
If you need to invest, then it's a very good answer, this. So Elvira, so if you have a high risk investment, you want also a very
The higher return.
okay. And the return is the opposite of the price, because the higher the return and the lower is.
Can you repeat, please?
Elvira, the higher the return and the lower, you said if there is a very risk investment, okay?
Mm-hmm.
You want
I don't understand what do you
okay,
mean.
let's say it again. When you have a very risky investment, you want what?
The high return.
Okay, and the higher is the return and the lower is. What we said before, what you observe on the market.
Price. And
Okay, so the higher the return and
the lower is the price.
okay. And at the end, there is an equilibrium between what? Between who is willing to invest in a risky asset and who is not willing to invest in a risky asset. So what would be the return of this risky investment? Is the equilibrium, again, between the different assessments, between those that think that the risk is very high or not so much high and so on. And then depending on this assessment, you will see a list of returns, okay? And talking about returns is also the same that talking about price, because price and returns are inversely correlated. Yes?
Yes.
Okay. So at the end, you see on the market the risk, how much is the risk is worth through the price. Okay? The value of the risk is priced. You can see it in the price. It's clear what I mean?
Yes, I understand.
Okay, so let's go ahead and finish what we said last time.
We finished that portfolio theory.
Sorry?
We have finished that portfolio theory.
Yeah. So what else we said?
That the person who wants to invest should create its own portfolio. Thinking about the risk that he can manage.
Okay. Vladislav,
Yeah,
you have questions about this?
what question, pardon?
About what Elvira was saying.
Honestly, I didn't hear the answer, the question, and I cannot said anything.
Vladislav.
Can you repeat the question, please?
No, it's okay. We were just trying to recap what we have done last time. So please focus on the class. Yes?
What we have learned.
Yes.
In the last time we have studied the types of risks, for example.
Yeah, this is what Elvira already said. And then what else?
Okay, just a minute. I have a weak memory.
Okay, Vladislav, do this before the class. I don't ask you to study, but just to read it, okay? Da?
Okay.
Good. Okay, so now let's start with the new class. Can you see the presentation?
Yes.
Okay. Okay, now we talk about markets, and then we give the definition. We said that there are different kind of markets, and then at the end, what is the common what is it? The common definition about markets is this: that is a mean in which people that are buyers and sellers can meet, and then in this place that they can exchange whatever, can be a good or a service. But then it is not required that is a physical location. So in the past, there was no internet, there was no, there were no phones and so on, and it was needed this condition that the market was, I don't know, in square, it was in an important city, but it's not anymore like that. So it can be any location. And then let's say that we talk about, apples. Who should have the apples? The market or the people that trade the apples?
People.
Okay, it could be the people, but Otabek, you answered correct? Hello? But it could be, Otabek, could be that those that are trading, could be that they don't own the goods?
Probably yes.
Yes, there are cases in which you are not the one that is growing the apples, no? And then also this is, and you can sell apples because you made a deal with the peasant, no? With those that grow the apples. And this is when you sell. And then if you buy Otabek, do you need to buy the apples for yourself?
No, it could be just for some speculative reasons.
Not only speculation. It could be because you made a deal with other people, then you will get the apples from somewhere, and you will bring the apples to another place. So either the buyer and the seller do not be, they don't need to be the final end users, no? But they could be just someone in the middle. And those people normally are called merchants, no? In the past, it was, now are traders, but in the past, merchants were the backbone of any economy, no? Because they could bring goods for anywhere in the world. So, and also, as I said, we can trade on the market whatever. We can trade apples, or we can trade, I don't know, securities. So then we said what is a market. Then let's discuss what is a good market.
I'm sorry, Giuseppe, could you hide the panel with instruments in PowerPoint so we will see the presentation better?
This way?
Okay, yeah.
Yeah, sometimes, sometimes I need to switch in this way, otherwise I cannot see you, okay? But yes, I can do it. And do you have my presentation, by the way?
We do.
Okay. So that's fine. So if for any reason I need to switch from this way from to the full view and so on, you can use my presentation. And Kirill, did you ask this question to me?
Yeah. I just, I mean that you made to hide the panel with in the with buttons, and we will see in this window the presentation in the larger form.
What do you mean, this way? Because the only way is this one.
Okay.
But then I cannot see you. So sometimes I need to see you. Okay. Okay, so let's go back to this. So there are, we said that there are different markets, and now let's try to understand what is a good market. So the first thing is about information. The information should be timely and accurate. Why we ask this this requirement? Rina.
Okay. You asked why we need accurate information, right?
Yes. Just a second. Vladislav, you have to put on the camera. Okay, so go ahead, Arina.
We need accurate information to...
Yes, why?
To receive correct price and...
why to receive correct price?
To buy things on the market for good price, for fair price.
Okay, let's start from the first word, timely. What is the meaning of timely?
Time to get information on time.
Okay. Because what happens if you don't get this information on time? What is the consequence?
There will be no equilibrium on the market, maybe.
There will be?
No equilibrium on the market.
Liquidity?
Equilibrium.
No, this is not... think about something different. So let's make an example. Let's say that... no. Let's say that is another thing, Otabek. in the sense that now we explain it, and then at the end we can get the thing. But first of all, Arina, let's say that you invest in what we said in a in a company, and then there is an earthquake, and then the factory is destroyed. So what would be the effect?
If I don't know that the factory is destroyed, I will believe that my investment will give me high return, but I won't get anything because I don't know the information.
Okay, so you invest in this company, and then if something like that happens, what you would do?
Do I know that something happens or not?
This is the problem. We are talking about information that should be on time.
Yeah.
So assume that you receive the information immediately as soon as the factory is destroyed, or you receive it after a month. What happens?
It's better to receive information on time.
Yes or no? But that is better. But why is better?
It's intuitive. I can't answer.
Yeah, but you have to explain things. You cannot say that things are like this because they are like this. Arina, you have this information now, or you have this information after a month? What? Compare the two situations and tell me why you want this information as soon as possible.
To make correct choices.
So, for example, what you do if you know it before and later?
If I know it before, I want to invest in this company.
You want? Sorry?
I want to invest in this company. I don't. I need to know information on time to react to the changes on the market.
Okay, so your decisions
depend on the information.
Are based on the information that you receive.
Yes.
It's clear. Okay, and then buy or sell, because what you do on the market.
I would sell.
Okay, in general, what you do on the market, either you buy or you sell. Okay.
Yes.
And then this, the decision about buying or selling is based on what?
On the price.
No, it's based on. We are talking about something here. What is the point? On the
information.
On the information. So based on the information that you receive, then you decide to
buy or to sell.
Okay. And then if there are many people that sell, what happens?
The price lowers.
Exactly. So that's why you want timely information, because depending on that, you take this decision on time, not a month later, but immediately. And you see the effect on the market through the
buying or selling.
And what happens if people sell?
The price.
So you will see the effect of your decision, of decision of everyone, based on
the price changes.
Okay, it's clear what I mean?
Yeah.
Now, can you justify it?
We need to get information on time to make correct decisions.
Okay. And also, not only on time, but they must be also
accurate.
Because why? what happens if they are not accurate?
And won't make correct decisions.
Okay, and so the price will be
Incorrect.
yes.
Yes.
It's clear, yes.
Yes.
Okay, so that
And-
is the first thing. Sorry.
Yes,
Please,
I have a question. And
go ahead.
why is it essential for us to have correct price? What happens if it's incorrect? Is there a necessary bubble or something?
Nick, we have to understand the what we mean by correct price. So you see that often in a liquid market, the price changes every time. What that means, that the price is incorrect every time?
No, it just changes because circumstances are changing.
Okay, because there is always an equilibrium between demand and offer, okay? And this equilibrium may change just a little bit or may change dramatically. And this equilibrium is also unstable in the sense that now, I don't know, the price is 10, after a second is 10.20, and after 3 seconds it is 9.8. It's clear what I mean?
Yes, it is.
And then that depends on many things, but one of those many things, what is it? The first item of this slide, what is it? Nick?
Yeah. I'm trying to understand
The first item of this slide, what is written there?
Information.
Okay, so depending on information, then you have this thing that the equilibrium may change. Of course, we said that we want timely and accurate information, because if the informations are wrong, then you will have biased prices. So back to your questions. The price is right always, only in the moment that you see it. But before that and after that, you don't know. It's clear what I mean? Because at that time, and the time when you see the price, there is a match between demand and offer. So exactly in that time, not before, not later, the price is right.
Okay.
It's clear what I mean? Because that is the equilibrium exactly in that at that time, not before, not later, between what is the demand and the offer.
Okay.
In this sense, the price is always right. But then, if you have your model that is about the valuation of a company, and then you find that the market has a different opinion from you, then maybe you can go against the market, and then you will see if that is a bubble, and it could be a bubble, or if you if you are wrong. So I don't know if you have seen, there is a movie that is called The Big Short, if I'm not mistaken. Do you know it?
Don't think so.
Yes,
Who knows it?
I know it.
So Atabek, can you share the link with your colleagues of this movie?
Yeah, of course. Just in a minute.
So also to the other group, please. So there you will see in this movie, you will see that the market didn't price well some securities that were based on mortgages. Do you know what is a mortgage, Nick?
Guess so.
What is it?
As I remember the definition, it's the I don't know the situation when you borrow some money actually from the bank to buy a building, a room, or something, and after that you are paying your debt. And if at some moment you are not able to, bank just gets your a room, and that's it.
Okay, essentially is that you, if you want to buy a flat, house, whatever, then you ask money from a bank, and then the bank gives you this money, but also you the bank has the right to, if you don't pay, to repossession the flat. So at the end, the owner of the flat or the apartment, whatever, the house, whatever is, will become the bank if you don't pay, okay? If you default. So that is a mortgage. And then your colleague has shared a movie, and then you will see that there were models that were predicting the fact that the securities that were based on this mortgage were not correct. And essentially, this is because in the West, there is something that is called financialization. I don't know if you heard always sometimes this term.
Does it mean that the financial markets are too developed?
That there is a reason why we have finance, because we have the economy, real economy, and I don't know, the real economy is tasked to produce goods and services, okay? But also you need finance because you need to provide liquidity to the real economy. But then when there is a detachment from the production, then when finance is not serving the economy, because it should be a mean to produce things. When finance is not doing this, but is making money from money, you can see it also in this movie, then it means that the stock market, for example, security market in general, not the stock market, the security market is artificial, and this is causing a big problem. So one of the reasons why we are in this situation is because of that. So, but there is a professor that you can read, that is explaining this quite well. I can write the name of this person, and if you want, later on I will share with you the name of this professor. But then this professor says something about this and explains in detail why we are in the current situation. So, but now let's go back to good markets. So the first requirement is about information, okay? Then let's talk about the second requirement, and then Vladislav. So what is written there?
Where? Pardon.
Vladislav, you have to follow the class. Kirill?
We talk about written on this slide,
Yes.
we have talked about timely and accurate information. And now I think we talk about the liquidity.
Yes, correct. And then can you say why a good market must be liquid? And what we mean by liquidity?
By liquidity, we mean that every economic agent could easily buy or sell.
Just a second, and Kirill. Sorry, you have the microphone switched on, please.
Okay, 1 second. I will.
Is your place? Okay, Kirill. Doesn't matter. Don't worry. So go ahead.
Liquidity is when every economic agent could sell or buy some kind of product very quickly. So, for example, we can easily buy or sell money, but it very difficult to sell, for example, a flat, because we need time to find.
Good, Kirill. This guy is good. You are right. And then liquidity is when you can sell or buy quickly. And then what about price continuity?
Price continuity is about I don't know.
Don't read the chat because it's not right. So let's see read the word and try to understand, to translate in something that is related to the market. So what means continuity?
Continuity is something without
without
1 second, without empty places. So
or yes, correct, or this is right, and then you have also a second thing.
There is no end and the beginning.
No, you don't have big jumps, okay? So if you remember the definition in mathematics, when you have a spike, then you cannot compute the derivative in that point. Yes?
Mm-hmm.
And why we need the continuity? Because we don't want what? We don't want two things. We don't want a moment. Well, it's difficult. We don't want a moment in which the price cannot be formed, okay? So we don't want empty spaces in the time series, for example. Kirill, can you follow me?
Mm-hmm, mm-hmm.
Plus, we don't want
also, we don't want that price don't have a derivative.
We don't want big jumps. So if the price is 10, maybe we can expect that the next price is around that number, so 10.1. Then 9.3, 9.5, but we don't want from 10 to go to 100 and then back to 1. It's clear what I mean?
Yes.
So we want price continuity. And then Joseph, go ahead, please.
Yes, low transaction costs.
Yes.
As I think, what does it mean? So we don't need a high price of commission to earn more if we would like to invest in something.
Good. Okay. And then next one.
More informational efficient. So we want to have full information because otherwise we can commit a mistake. So we will have more risk to lose our money.
So we said before, we discussed about before. Before we discussed about the information. Okay, we said that information should be what?
We should have full information, or
no, what is written before? So at the top.
At the top?
Yes. Information should be? Joseph.
Accurate.
Who said it?
I said it.
Okay, Otabek. Sorry. Otabek is right. What is written at the top? Joseph.
Yeah, I understood timely and accurate information.
Okay. So we said it. No, we said it for 10 minutes. And then what we mean by informational efficient? That what we said that is the main thing that we observe on the market.
What is
what we observe on the market? What is the main thing, the most important thing?
I don't know.
Could you please repeat the question?
Or
we share on the market or serve on the market?
What is the most important thing, the main thing that we observe on the market?
Maybe that we want to get
no, what we see, what we observe on the market.
How the prices changes on
the price, Joseph, price. That's it. Price. That is the main thing. Okay. If you go to I don't know, to the market, what you see at first glance? Let's say that you want to buy bread, some bread.
Yeah,
no?
I look at the price.
Yes, you look at the price. So that is the first thing. If you go to a restaurant, what you see? The first thing.
The menu, but in the menu are prices.
Yeah, the prices. Okay. So we discussed about the information. So what those informations that must be, we said, which characteristic we want about the information, how the information be.
You mean timely and accurate, or?
Okay, stop. Timely and accurate. Those the information should be timely and accurate, and then they should be reflected into.
No, one more time. They should be what?
Reflected in the main thing.
In prices.
In prices. Okay.
Okay.
So a market is informational efficient when you see that the information that you receive are reflected into prices. So we made an example before about earthquake, okay? Joseph, can you follow me?
One more time. We could make what?
Before we made an example. we made as an example the earthquake. Do you remember? A factory earthquake? A factory that is destroyed?
Not really, then.
You don't remember it?
No.
Arina, do you remember it? So what we said before? Arina, what we said before?
Before what?
About information, about the factory.
We said that we need timely and accurate information.
Yes, and then we made the example about the factory. So what we said about the factory? Otabek.
We talked about its destruction.
Yes, and then?
We were talking about timely and accurate information.
Yes, and then what we want to know if the factory is destroyed?
Maybe we want to know how fast as...
Sorry, just a second, Joseph. Now is Otabek is speaking.
Yeah, we want to know that the factory is destroyed on time, not after a month or
exactly.
or even a day.
Exactly. So as soon as possible. And then we want to know maybe the how much is the loss, no? Because it could be that is completely destroyed, is partially destroyed, and so on. That is what we want to know as well, okay? And this information should be reflected into prices, because based on this information that is timely and accurate, then what we do, Otabek?
We can make decisions about
exactly
on the
market. We can make decisions. And what is the effect of this decision?
So, for example, if the factory is destroyed, I think that it's logical to sell the assets that we bought on the market.
Okay, it's logic to think that the company is worth less.
Yeah.
Yes, and then the price of this company should be lower. So I need information, but also this information must be reflected into prices. So not only I want information, but also I want that this information is reflected into the price. Is that clear?
Yes.
Okay, good. Now let's move to next slide. So those are the characteristics of a good market. Okay, so let's talk about information. We made an example about the destruction of a factory, but then there are things that also can be directly observed in the market after the price, because we said that the price is the first thing, no? But then there are volumes. So how many stocks are bought or sold, no? The transactions. So volumes is what I told you, is the number of shares or the number of bonds that are sold or bought. And then what someone can observe on the market, these are all, what I'm saying is all about market information. So things that you don't need to get from outside, because in the example that we have made before regarding the earthquake, this information is from outside, the market. No, it's something that happens not in the market, but somewhere else, okay? Then there are information about the market, and those information are, as I said, regarding volumes, regarding price, regarding bid and offer. Otabek, what is the bid and offer?
Bid is the price that is suggested by buyers, and offer is what is offered by seller. I cannot say exactly.
Yes, correct. So the current bid, what is the meaning of current bid?
Probably how the market is evaluating current asset.
So overall, the price at which people
would like to buy.
Exactly. And then offer is the opposite, okay? The price at which people would like to sell. And we said this many times, and we will say it, and we say it again. So there are different prices on the market, because someone wants to buy at 5, someone wants to buy at 10, someone wants to buy at 1, and the same happens on the other side. So someone is happy to sell at 3, someone is happy to sell only at 100. But then what you observe on the market is the equilibrium between the bid and the offer, okay? And these are definitions that you can read by yourself. Price liquidity, price continuity. In this way you can read it better.
Can we be not in the condition of equilibrium, but just moving towards it? So to have a lack of bonds, so we have high demand but low supply, or vice versa. So equilibrium isn't always the case, right?
No, when you have a price, you have an equilibrium, because there is someone that has sold and someone that has bought. So if you don't have an equilibrium, that means that there is no price.
Okay.
It's clear? And then this is back to what we said before with Kirill, no? We said that the condition for a good market is that you don't have periods in which there is no price. So this can happen, but if there is no price for a period, that means that you have a market, but maybe it's not a good market.
Okay.
Okay. But every time that you see a price is because someone is trading, is exchanging that good, that service. So if you sell, I don't know, pizza for 1 million rubles, maybe no one is going to buy the pizza from you. But is that pizza offered on the market? Yes. And then if you find someone that is available to buy it, maybe it's good, because then you have at least once you have someone that is trading, is exchanging that good for that money. It's clear what I mean, Nick?
Yes, it is.
Other questions? Okay, so here, switch on again. So here I explained what I said before, but then these things, liquidity, price continuity, and these things you will read by yourself. You don't need me. And then let's talk about types of markets. There are two kinds of markets. One is the primary market, and the second is the secondary market. And the most popular is this one, the secondary market. Why? Because in the primary market, there are issued new securities, and then let me see it. Tanya.
Yes.
So, in your opinion, which market is bigger, the first one or the second?
Well, apparently, because outstanding securities are securities that were not issued and not diffused or repaid, then the primary market is bigger.
Okay. Do you know the meaning of outstanding?
Yes.
So securities that have been already issued.
Mm-hmm.
So do you see every when you see
the secondary market is bigger.
Yeah, because there are new securities issued on the market, but the outstanding securities for sure are much more than the new ones, no? Okay. So the second is more important in the sense that is bigger, at least in this sense. And then, what time we finish? It's
in 15 minutes.
15 minutes, okay. Then let's go ahead. Can you comment about this?
Yes. If we're talking about the bonds, then we of course have the issuers, so the person.
And we already mentioned this. Who is the issuer? No. And then what is the maturity?
The maturity is the period when an owner will receive the interest payments on the investment, and the placement is the market.
So the maturity is how long this
the period
security is existing. So after the maturity, there is no any more security, no? So that is the kind that when you buy, I don't know, milk, for example, no? You have expiration.
Yes.
How do you call it? Moloko?
Yes, Moloko.
Okay, good. So you have an expiration there. And the same is for bonds. And then you have a placement. What is the placement?
The market.
The way in which securities are
operated,
are placed, are sold on the market, no? Good. And then let's go ahead.
If we're talking about the equities, we have the privilege. So the factors that are more important that we look at when taking decisions, the issue.
So privilege, let's talk just a second about privilege. Then there are shares, maybe already discussed this, that can vote, or shares that cannot vote. Where the stockholder in which situation vote?
Vote for what?
Yeah, exactly. Vote for what? Let's say that you have some shares of a company. Do you have case is there a case in which you can there is a case in which you vote or not?
Well, you either have the right to vote or not.
Correct. But what about this vote? Is vote for what? When happens? When you can exercise this right?
Taking in the bond or not taking it in?
No, we are talking about equities now.
Well, the equity, yeah.
Yes.
Well, they have, for example, many people that take a decision and you either vote or not.
Okay. In each company, there is something that is called General Assembly. What is it?
The people that make decisions on purchasing goods and services on the markets, the
No.
bonds and
No.
and
Let's say that we talk about a company, okay? And you are a shareholder. When you can exercise your right to vote? A vote is to take a decision. When you take a decision, every day?
depending on their strategy. When you want,
You do it once a year at least. When this happens? Did you study corporate finance? Corporate
corporate finance? No.
and
Just
finance only?
General finance, yes.
General finance? And do you know that there is a situation once a year that which as a shareholder you can vote?
Yes.
And why you don't tell me? So tell me about this situation, please.
There are people that are that have they are part of the company and they make decisions on buying or selling the assets that belong to their company, either to raise their income or I don't know, not to get a default in the company. They overlook everything that was on the market and the things that happened in their company and make decisions.
No. Is anyone able to explain this, or I should tell you?
So we have a shareholder assembly once a year.
Okay,
where
good.
Management stuff is discussed in the board of directors, I guess. Just shareholders.
No, there are two things. No, that is not a matter. Okay, I try to explain it. Okay, this to everyone. Okay, so companies, they need to run every day their business, okay? Tanya? Can you follow me?
Yes, I am.
Good. Then, who is running the business? The management. And who is the head of the company? Normally is the CEO. Do you know this? Chief Executive Officer. This guy is appointed by the board of directors. And this board of directors takes some decisions based on the report that he receives by the CEO. So maybe once a month, there is a meeting and the CEO says to the board of directors, things are going well, they are going bad, they are going so and so. It's clear what I mean? Yes, Tanya? And then every year, there is a report by the board of directors and the CEO to the shareholders. So the shareholders are the owners of the company, but they cannot be involved every day in the decisions. They cannot be, and also because maybe there are millions of people, no? You can involve million people in the decisions, okay? So what happens? That once a year, the main decisions are presented and the results of the company are presented to the board, sorry, to the general assembly of the shareholders. And then the shareholders, then they can decide if they are happy or they are not happy. They can vote for or they can vote against what the CEO and the board have done. Is clear to you, Tanya? And then one of the decisions that is made there is, for example, if there are profits, how much the part that this profit can be distributed as a dividends. And this is important because if you are a shareholder, what do you want? Tanya?
You want more income and money.
So you want dividends. Okay? Not only you want that your company is running well, but also you want to get money for your investment. Tanya?
I'm here, I'm listening attentively.
Yeah, but we are trying to make a discussion. It's not
Yes,
just...
yes, I agree. Totally agree.
Okay, good. So then there are shares that, for example, can vote and shares that cannot vote. This is an example, but privilege can be different, can have different meanings. So let's go to the second one. After privilege, what we have?
After privilege, we have the issue, and it's when it is the sale. It is the sale of a new equity that is done by a company to investors.
Exactly. This is new equity, for example, no? And then placement is like the previous one, no? The way in which you sell on the market things. Okay? Good. Now, let me go back to... Okay, this is something that you can read by yourself. Maturity, placement. Yeah, you read everything by yourself. Then I will explain you this slide. So, of course, if you don't understand something about what is described in the previous slides, you ask me next time. Okay, so we said that there are different kind of placement, and this is an example, a typical example. So there is a company that is issuing stocks or bonds, whatever, no? And then this scheme, we have an underwriter, is the one that is buying completely this issue. And then this underwriter is the lead of a number of other companies that normally are investment bankers. And then this underwriting group is selling the same issue to investment firms. Those investment firms, either they keep the issue with them, or they sell to some other investors that could be either institutions or individuals. Let me ask. Arina?
Yeah, can you repeat, please?
I didn't ask the question.
Okay.
So, can you make an example about institutions?
Institutions, maybe some companies.
We are talking about investors. So, I don't know, Gazprom does buy shares of other companies, like, I don't know, a grocery store.
maybe.
Yes? Arina,
Yes.
please try to be, more plausible.
Okay.
So what can be an institution in your opinion? We are talking about investors, okay? It's clear what I mean, investors.
Yes.
So in Russia, you have a big investor. The biggest one, who is that?
I don't know, maybe Gazprom.
Sorry?
Maybe Gazprom, I don't know.
Is not an investor. Gazprom is producing gas and is selling it.
Mm-hmm.
Who is the biggest investor in Russia?
Government.
Government.
Well, not directly the government, Nick and Rina.
Mm.
But there is an institution that is doing that. You know it?
Yes, we do.
Yeah. Tell me the name.
So it's not directly the government. It's some kind of, I don't know, government organization who
Tell me the name,
which
please. Look on internet if you can, but tell me the name.
okay.
Rosgostrach, maybe.
Alina, I cannot speak Russian, so say it another way. What is this Ros? What you said?
Rosgostrach, maybe Russian government insurance.
No, it's not insurance. Is Russian
government orders.
government?
Something.
What?
Government orders.
No.
No.
Is a wealth fund. Is the Russian wealth fund? I cannot say the name in Russian. You should know it. Look on internet. Well, this. Can you find it?
Not really. Only the state order.
Well, it's owned by the state, but is
maybe hedge
is
fund.
not. No, it's not an hedge fund. It's a wealth fund. Let me check it. Yes, exactly. This one. Kirill is this one. Okay. This is the biggest investor, Russian investor. And this investor is buying shares for, securities, not shares, because of this institutional, institutional requirements that needs to fulfill. So institutions can be, again, investors can be, again, individuals or institutions. And wealth funds are very common, especially in countries that have a lot of raw material, that energy. So you can see the same for Norway. Yeah, it's finished. You can see the same for Norway. You can see the same for Saudi Arabia and so on. So with this, now we finish the class, and so see you next time. That would be the 20th, no? Hello?
Yes.
Okay. So we'll discuss your questions next time. Bye-bye.
Bye.
Goodbye.
Nick, can you please
Yes.
stay just a second, because I need to share with you.
Yes. Okay.
The name of this professor. Just a second, okay? is the one that is explaining the issue regarding what I mentioned before. When a market finance is too much detached from real economy.
Okay.
Where is it?
If anything, you can send it to us via our mail.
Yeah, I can do it, but I had it with me now a few minutes ago. Okay, this guy, I'm going to send it, to write it here in the chat. Okay, so look, there are some classes from this guy on internet. Can you read it?
Yes, I can.
Okay. See you. Bye-bye.
Bye.